Greetings, accounting students and teachers. The break-even point comes under the price setting topic. Today, I'm going to start with a bit of background theory, then we'll go through a very simple practical example. Always useful to start with a definition of the key concept that's being covered. In this case, the break-even point, which I'll abbreviate from now on to B.E.P, basically is a calculation and determination of the number of units that an entity needs to sell in order to cover both their fixed and variable costs. There is a formula that you will probably need to know when you are being assessed on this. So our numerator is fixed costs, our denominator is our selling price minus our variable costs. We can adapt the formula to also feature target profit, but I'll keep that up my sleeve for a future video. So once we have the what is break-even point, then it's pretty useful theoretically to look at why. What's the value for an entity to calculate the break-even point? Well, number one, it helps with price setting. Now, there are a variety of forces that come into play when entities look at setting prices for their products, such as what is the competition charging? What's the recommended retail from our suppliers? What are some of the other market forces that come into play that affect what consumers are willing to pay? It also helps us with our cost analysis, particularly with our variable costs. It might help us kind of, I guess, bring into focus costs that are exceedingly high that will impact the viability of the product, which leads into the third point. If the break-even point is calculated to be excessively high, to a point where it's just simply unrealistic to be able to sell that many units in order to cover our costs, then an entity, before they basically lose any coin, can make the call, well, let's not launch this product. Let's look at plan B, C, or D. And finally, calculating the break-even point using the formula, it also helps us with target profit setting, which again, I'll keep up the sleeve for a future vid. Now, the critical thing here is that students are able to differentiate between the two numbers that appear in the denominator of our formula, fixed and variable costs. So a fixed cost will not change regardless of the units sold. So even if we sell 0 units, i.e. there's no demand, we will still cop those fixed costs, e.g. rent on a building, or wages if it's a staff member that is paid on a full-time basis. A variable cost will increase uniformly, so we can accurately and logically calculate the cost of the raw materials, the input into that actual product, and it will increase uniformly with each additional unit sold. So some useful terminology here is your contribution margin. Your contribution margin simply is the subtraction of the variable cost per unit from your selling price, which represents the contribution margin for each unit sold. And that ignores the fixed costs. They're still relevant in the calculation of our break-even point, but just a useful piece of information to help with decision-making moving forward, particularly when we're trying to control our variable costs and then being mindful of the impact of the fixed costs on the break-even point. So let's go through a practical example here where we've got a Year 11 formal committee, and it's their job to basically plan and run the economics, the finances of a formal for 2024. So here's a series of estimates of costs, etc. And basically the committee has decided to charge $100, and they want to work out in advance if that's going to be viable given all the quotes they've had on these various items in terms of running their formula. So therefore, they're going to calculate the break-even point. So to solve, we take a 3-step approach. Step 1, we work our way through our list and distinguish between our fixed and variable costs. So let's do that now. So the $100 per unit, that's our selling price. That's important in terms of our calculation. The band is a fixed cost. If we don't sell a ticket, we've still got to pay the band. Same with advertising, that's a fixed cost. Food per person, so there's a variable cost. With each additional ticket we sell, that's $25 worth of food that we've got to basically fork out for each of our guests. The venue hire. The venue doesn't care how many people are coming. That's a fixed cost. That won't change regardless of how many tickets we sell. Ticket printing, if they want to go a little bit fancy with some laminating, that is a variable cost. It will increase uniformly with each additional ticket we sell. Likewise, with drinks per person, let's presume that's non-alcohol, given it's year 11. A DJ, I know that's pretty cheap, but let's just presume it's a young kid. That would be a fixed cost because we've got to basically determine that in advance. And likewise, the security guard. So that's step one. We've basically identified our fixed and our variable costs. Then we total them up in terms of our numbers. So if we total up all our fixed costs, 1,000, 500, 2,000, another 500 here, 1,200, that equals, fixed cost equals 5,200. And then we calculate our VCs. Let's change color here. We've got 25 there, plus 2, plus 10, so that equals 37. We're nearly there. Then we use our formula. Fixed costs over selling price minus variable costs. So our numerator is 5,200, our fixed costs. Our selling price up here, $100 per ticket, minus our variable cost here, 37, 5,200 divided by 63 equals about 82.5. But let's round up. We can't sell half a ticket, so we'll have a slight profit. So our break-even point is 83 tickets.